You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 21st of July, 2026, and I'm joined today by my co-host, John McEwen. In this week's episode, we'll be discussing Ocado, Barratt Redrow, Funding Circle, ASML, ITV, and our US company of the week is Intuitive Surgical. John, shall I start us off with Ocado?
Yes, how are they doing?
Not brilliantly, it has to be said. Ocado's first half revenue rose 54% to $1 billion. However, that was driven by a one-off compensation payment from Kroger and Sobeys for the cancellation and early closure of their Ocado-run customer fulfillment centres. Not really 54%. And then as well, the fact that people are cancelling these customer fulfillment centres is not good. Excluding these payments, revenue was only up 1% to $700 million, and underlying cash profit, EBITDA, fell by 11% to $81 million. Weakness was driven by double-digit declines in technology solutions, offset only marginally by slim growth in logistics. Free cash flow improved from an $83 million outflow to a $75 million inflow. However, that was driven by the compensation payments. Net debt, including lease liabilities, fell by $100 million to $1 billion. Full-year guidance was reiterated, with technology solutions growth expected to be around $500 million, and that's down from growth of $600 million a year ago. Logistics revenue is expected to grow by mid-single digits. Several planned consumer fulfillment centres are set to open between 2026 and 2028, or they were, but they've been delayed by 1 to 2 years. And the shares were down 15% following these results. Just to reiterate, they've got 6 fulfillment centres planned over the next few years, which have been pushed back. And in terms of the split, so the logistics business is the picking, packing and delivering of groceries for third-party retailers such as Morrison's. That's growing okay, but margins aren't very good because it's the least profitable part, and that's probably why Morrison's are quite happy for Ocado to take it off their hands. And Ocado Retail, which is the grocery business half owned by M&S, that's doing better and is actually gaining market share with volumes improving. They are targeting being free cash flow positive in the second half. However, that's mainly been driven by major cost cutting rather than growth. And to be frank, with these figures, it actually looks quite ambitious. So it wouldn't be a surprise to see that push back as well. In terms of the valuation, doesn't pay a dividend, obviously not buying back any shares, and no earnings. Forward price to sales is 1.01, but that compares to a 10-year average of 2.66, but it is growing a lot less than it used to. Yeah, I'll just have a look at the share price. Yeah, so over 5 years, the shares are now down over 90%. So it's 91.16. So really, really not good. I think these are obviously not very good results. Market cap's still 1.6 billion, given the amount of cash flowing out the door, which I'm skeptical about that being reversed. It wouldn't surprise me to see an equity raise at some point. I don't think it's quite Aston Martin levels. I think it's some way away from that. But I think at some point, it really wouldn't surprise me to see it have to do an equity raise. What about you, John?
Yeah, I think it's uninvestable for me, Sam. I just wouldn't go near it with a barge pole.
Should we move on to a business that you do own then?
Yes, so Barratt Redrow, which is Britain's largest house builder, had a full year update out last week, with completions growing by 5% to 17,667 new homes last year, which was towards the top end of the group's guidance range. Average selling prices rose 2% to around £352,000, helped by a shift in mix to larger homes in more expensive regions. The order book edged down by around £100 million to £2.8 billion, and the net cash position remained flat at around £800 million. Build cost inflation was 2% over the year, whilst the integration of Barratt and Redrow delivered £53 million of cost savings. As a result, 2026 full-year underlying pre-tax profits are expected to land in line with market expectations at around £560 million. In 2027, new home completions are expected to rise between 17,700 and 18,200, with minimal house price inflation. Build cost inflation is expected to rise between 3 and 4%, and Barratt expects to return around £400 million of cash to shareholders this year, primarily through share buybacks. and the shares were up around 2.3% in early trading. In terms of valuation, Barratt Redrow has a market cap of just under £4 billion and trades at 0.49 times forward price to book, compared with a 10-year average of 1.03, and it has a prospective dividend yield of 4.8%, with a net cash position of around £800 billion. It's very interesting. We've spoken about the house builders and Barratt Redrow in particular on a number of different occasions. Very interestingly, in the last few weeks, there has been a paper which has been published by Phoenix Asset Management Partners, who have been building up a stake in Barratt Redrow, about the long-term value investment case for it. I think it's probably worth just reading out a few points from this report. Quite a lot of it in terms of the investment case for Barratt Redrow, but also the other house builders, he's got quite succinctly on, I think it's page 3. So I'll just go through some of those. So, nature of the demand. Demand for housing is predictable. It comes from household formation, which is a function of population growth and factors like ageing, coupling, and net migration. Supply is constrained by the UK's local-based planning systems and the attitude of communities against new developments in their area. House prices are a function of that interaction between supply and demand. High prices are the way household formation has been slowed to match the lack of supply. An undersupplied market means that developers can always sell their properties, even if or in a disrupted market, they have to find the lower price to find the landlord bid. This means a UK house building business can be modelled with the knowledge that cash will keep coming in, especially in a downturn. They also go on to discuss the competitive landscape. So barriers to entry have risen to prevent the entry of new competition in scale UK house building over the last 50 years, despite a number of attempts. So these come in 3 ways: the difficulty scaling a UK house builder successfully, 2, the rising costs of regulation giving advantage to scale, and 3, the difficulties in securing land that favours the incumbents. And this is evidenced by the fact that the newest house builder in the top 10 was started in 1974, and the concentration of the top 10 has, through that time, increased, and the number of small builders plummeted. Although house builders are price takers when it comes to selling because of the anchoring effect of the much larger second-hand market, they are price setters when it comes to land, and their scale advantage in cost of build make them the best bidder. So let's just have a look a bit further down. So business model, pricing power should result in higher post-tax returns on capital, which it does. The CMA in its recent study found that large builders earn mid-teens long-term returns versus around 8% for UK companies as a whole. And one of the key issues, house building financial statements are confusing, often misleading, and at a minimum opaque. So that may go for what I've just read out. The returns are hard to see, and the noise gives the impression of a much lower quality business. There is a divergence between accounting, profitability, and cash generation, which is often material. This is because of the long timing mismatches between when land is bought, when it is worked on, and when the final product is sold. The most misleading time is when the profit and loss most understates value is after the volume falls and either price falls or build costs rise excessively. And we had those conditions plus a merger that obscures further, plus a war with Iran on top. And this is really where it comes to the investment case, particularly for Barratt Redrow in this case, but I think a lot of things could be applicable to some of the other big house builders. So the value proposition, Barratt Redrow is selling at an absurdly cheap price no matter how you define it. So 40% discount to tangible net assets, 67% discount to liquidation value, 40% discount to liquidation value in a 25% property crash scenario, and an 80% discount to our estimate, so this is Phoenix Asset Management, of intrinsic value per share. Now, this is where I think it becomes quite interesting what they are suggesting should be done about it in their investment case. So the case for buybacks, so share buybacks. If a sector is prone to long-term undervaluation because of noise, opacity, cyclicality, politics, then using all excess capital for buybacks creates extra value for those shareholders who remain. Barratt was stung by how leveraged it was coming into the 2008 financial crisis and how much value was destroyed through the dilution of the equity raise in 2010. We know because we were the largest shareholders then. Since then, it's completely reversed that position to a net cash position, which is around 800 million. And following the reduction in volumes and the merger with Redrow, it has a land bank of more than what it needs. It can therefore have a material buyback program. We showed how value creating a more aggressive buyback strategy is. At just £500 million a year, the company never even gets geared. And even if the discount to tangible net asset value closes in the first 2 years, then they trade at book. After then, over 5 years, the shares rise to 782 pence a share, which is 3 times the current share price for an internal rate of return of 25%. Continue over 10 years and the price ends up at £16.09 with an IRR of 20%. If Barratt gradually returned to the modest level of growing of gearing that was agreed at the time of the rights issue, and which we think does not imperil the business through troughs or dilution risk, then you can see in that scenario, over the next 5 years, the share price would reach £10.21 if the shares went back to the tangible net asset value in the next 2 years. But if they stayed at 60%, then you get an even bigger effect from the buyback. And in 5 years, tangible net asset value is £25.69. And so even trading at a 40% discount would be £15.69 for the 42% annualized return. We show that if a post-rights issue in 2010, there was no unwind of the leverage, but instead a buyback program at the prices the shares traded at over the years, then TNAV would be £14.69 for an annualized return of 20%. So anyway, I think it's an interesting case. I do like Redrow. I have recently added to my holding, not by a huge amount, but probably topped up on it by, let's say, 20%. And I'm quite happy holding. My view is I'm not sure that this buyback strategy is going to happen, but I do think the fundamentals are there and we're in a fairly dormant part of the cycle with the structural issues that we have in the UK. I would hope that whether they are sorted out by this government or whether it's another government at some point, if they sort of take a step back on regulation and planning, that we might see these house builders take off. And I do think they look very cheap at the moment. I'm happy with the share buybacks that they're currently doing at current prices and reinvesting the dividend. But I thought that was quite an interesting analysis, particularly in terms of the market as a whole. And it'd be, I think, quite similar, it would be fair to say, Sam, what we thought previously.
It is really, really cheap historically. One thing that I'm maybe not so sure on is in terms of ramping up these buybacks, just to confirm. So net cash currently 800 million, market cap 4 billion. How are they proposing to fund these? Is this that you just stop buying new land so you don't have that expense anymore and let that land bank basically wind down?
Yeah, that's my understanding of it.
I can see the logic, but at some point you're going to have to start buying land again. So I guess you could argue that if the value's there, if they own the land, it's still going to be unlocked at some point.
Yeah.
It might take longer, but that value's still there, whether it's in the form of land or a lower share count.
Yeah.
So I don't know. It's quite... I can see the logic, and I agree with the general argument in terms of all sort of the tailwinds that it has in it as an industry, or should have at some point. But in terms of these kind of short-term buybacks, I don't know. I can see the argument for having like a nice land bank cushion as well, because that land still works. It's not, it's not like it's wasted.
Yeah, no, I do take your point there. Would today's valuations tempt you at all?
11 PE, 6% yield. So actually, when you look at last couple of years, they've actually been generating less cash. And the reason is it's all going into working capital, which presumably is the land. The dividends are lower. And the buybacks are quite low. I do take the argument. So last year, they actually had a change in working capital. So every year, so 4 of the past 5 years, the change in working capital has been 250 million plus, which isn't small figures. So yeah, I can see the argument actually. Yeah, I don't know. I don't know if it would tempt me because the problem is it's like I've watched you hold shares for 10 years.
Yeah.
The value's clearly there. I don't think there's any doubt about that. But how long do you give it for someone to actually come in and unlock it?
Another 10?
I think if you're an activist investor and you can publish a 100-page report that maybe forces the change you're looking for, you'd be a bit more optimistic. But I think the value is there. It's just how long do you give it with these businesses?
Yeah, no, fair enough. Fair enough. Okay, then. On to Funding Circle.
Yes, I believe this is a debut on the show. So Funding Circle, for anyone who's not familiar with it, it is a lending platform. So if you've got a business, you can basically go onto Funding Circle and you can get loans. So this next bit is coming straight from the company's website, but Funding Circle is on a mission to back the small businesses that power our economy. 73% of applicants receive an instant decision. At the heart of our business is a proprietary technology and data engine that connects small businesses with high quality funding from a diverse range of institutional partners. In terms of what the borrowers actually get, 60% get term loans, 33% get FlexiPath line of credit or cashback credit cards, and 7% get marketplace loans. I'm not entirely clear what that 7% actually means, but basically it connects you to like institutional investors, which provide 93% of the funding. They can also help you get government loans as well to start the business. So yeah, basically it's a funding platform. Funding Circle have come out with a half-year trading update, and they've said that building on the performance achieved in 25, they've had a strong first half of 26, and that was underpinned by new product innovation, in particular the new shorter-term loan offering offered at the end of the half year of 2025, which is now contributing. Revenue grew 50% to 138 million. Profit before tax was about 23 million, and that's up from 6 million a year ago. And that compares to 20 million for the last year, for the entire year, not just the half. Overall credit extended was 1.7 billion, and that's up from 1.1 billion for the half last year. And assets under management grew to 3.3 billion, and that's up from 2.8 billion a year ago. Cash balance is 136 million, and that's up from 101 million a year ago. This increase reflects trading performance and the monetization of the shorter-term loan portfolio, partly offset by the ongoing share buyback program. Terms loan business grew originations from 736 million to 1.05 billion. Term loans continues to demonstrate strong operating leverage and high cash generation. We continue to have a strong funding pipeline for the next 2 forward flow agreements totaling 900 million. FlexiPay and card business is up 71%, with assets under management up from 169 to 300 million. We renewed and upsized our long-standing funding facility with Citi in April. This now stands at 400 million, including our equity. This strong first half performance puts us firmly on track to achieve our full year guidance of at least 235 million of revenue and at least 35 million profit before tax. We remain capital light with a robust balance sheet. A third share buyback of up to 25 million was announced, which is ongoing. Combined with earlier programs, the company has bought back 18% of issued share capital to date. In terms of the valuation, the business trades at a PE of just under 13, but it doesn't have a dividend. They're in a current buyback of 25 million. That's on a market cap of 542 million. So that's about 4%. So it's a decent return there. And in terms of the market cap, that's 542 million. So it is FTSE 250 listed. I think its trading statement seems positive. We've obviously not covered it before. It was a business I was familiar with, but that's from years and years ago. When I used to prepare tax returns, actually. So occasionally I would see it on a tax return where a client had income from Funding Circle. I did have a look because that didn't seem to be what was being described here. So it actually started as a peer-to-peer lending platform, and then it's pivoted to institutional lending for the small businesses. I think for me, it's just a business that I kind of struggle to understand. I get that it's capital light and it's just kind of connecting those small businesses with the institutional investors. I can see the appeal of that kind of platform, but I guess as someone who's not an institutional investor or a small business, I struggle really to kind of almost understand what the moat is, other than the fact it's just got a convenient platform. Yeah, I just think it seems a bit hard to wrap my head around. I would have been probably more interested in it had it remained peer-to-peer, because I can kind of conceptually, I can visualize that a lot better and understand what it's doing. But on the surface, it does look like potentially a decent business, just albeit not for me. Maybe I'd have to come back to it and have another couple of looks at it. What do you think, John?
Yeah, no, I would agree with you about that uncertainty regarding the moat. I think the other things are that it's likely to be very cyclical, and it's almost entirely based on how the UK economy is doing. I think that's probably reflected in the valuation at just 13 times earnings, but that would be, a very real worry. And obviously, when things are good, fantastic. When things are bad, I think things could be very bad for Funding Circle. And that would probably be the biggest worry.
Should we move on to ASML? Have they gotten any cheaper?
No. So I think they've got more expensive. I'd have to go back to the last time and just check on that, but I'm pretty sure it's more expensive. So for anyone who doesn't know, they're the maker of the lithography machines that are used in semiconductor construction. So as you can imagine, they've had the second quarter results out this time, but as you can imagine, with the huge boom in AI, there's been an increased demand for their products, and essentially it's a near monopoly in that sector. So they beat their expectation and they raised their full year outlook, with second quarter revenue up 21% to 9.3 billion euros, with a gross margin of 54%, and operating profit rose 30% to 3.5 billion euros. Free cash flow rose from around 300 million to 1.3 billion, and there was net cash on the balance sheet of 5.6 billion euros. An interim dividend of 1.88 euros was announced, with around 1.1 billion euro share buyback over the quarter. And for the coming quarter, revenue is expected to be between 11 and 12 billion euros, with gross margins of between 55 and 57%. For the full year 2026, revenue is expected to be between 43 and 45 billion euros, compared with the 36 to 40 billion previously guided. And gross margins, again, 54 to 56%, and they were previously guided at 51 to 53%. And the shares are up 6.6% in early trading. In terms of valuation, ASML has a market cap of 590 billion euros and trades at 40 times forward earnings, compared with a 10-year average of 31.4, and it has a prospective dividend yield of 0.6%. Truly incredible results on the back of the AI boom. Really, really high quality company with a huge moat and surprisingly capital light model. It's really difficult to know how long growth can continue at this rate and how much investment in AI has been pulled forward. I guess the difficulty here is that if there are any hiccups in the demand, basically, then these shares could fall a lot. But what a business. I think, again, we covered it before, and I think we thought it was still quite expensive when it was about 30 times forward earnings. And now I sort of look at it and think, actually, when you're seeing things continuing and the longer we cover it, I do have regrets about not buying in previously, but I don't think I would be brave enough to buy individual shares in this company with a market cap of 590 billion. But I'm sure I have a decent enough allocation to it in a global tracker, but it's very expensive to own that as an individual stock, and potentially the volatility that's going to go with it if we get more mixed results coming through on the AI front. Sam, what are your thoughts?
It's a bit upsetting, actually, because I have just looked at the share price. I think we started covering it in 2024.
Yeah.
When you look at the share price, it kind of ran up to, appreciate these are the price rather than the multiple, but it ran up to €1,000 a share in 2024, which is probably around when we started covering it, and we were not paying that. Pulled back all the way to €577, and that was just over a year ago. And I think at that point, like you say, it was still really quite expensive. I don't think it ever dropped below kind of high 20s PE, albeit with excellent growth. It's now gone from a low a year ago, 577, and it's now 1591. So you're not getting far off from tripling your money.
Yeah.
So it's just a fantastic business. You see that in the results. I don't think it's ever put up a disappointing set of results in the time we've covered it.
No.
It's probably got one of the best moats on the planet, which, we've talked about in detail in previous times when we've covered it. But to actually get into this industry, the amount of money you would have to spend, and they've basically got a monopoly because no one else can do it, and it's so expensive to get into it. And to actually knock them off the perch, really, the only thing you could actually do is buy them, which at a market cap of 600 billion is easier said than done, although there are a few companies that could do it. But yeah, it's just, fantastic business. I'd love to own it, but I can't see it ever getting to a price at which I'd be willing to pull the trigger, because I think if there was a price, it would have been a year ago, and even then I still didn't
It was
think
too
it was cheap
expensive.
enough.
Yeah.
Yeah, so fantastic business. I'm just in awe of it, really.
Yeah, no, fine. Okay, on to a business that you're probably not in awe of.
No, so ITV. So there's no results out, but we did cover the results recently, and we said that they were looking at selling their media and entertainment business, and there was talk of that going to Sky. That has now been announced. So a deal's been agreed. ITV will receive consideration of up to 1.6 billion if the deal completes. That's 1.2 billion up front. Yeah, so the deal needs regulatory approval. I think 10 or 15 years ago, it wouldn't have got regulatory approval, but you think in this day and age with the Netflix and the Amazons of the world and the Disney Pluses, I think it probably will go through fine. And it's expected to close in the second half of 27. On completion, they expect to return 950 million to shareholders, and the guidance remains unchanged. So the media and entertainment division, which is being sold, that includes the broadcast business and ITVX, really. So it's actually the TV channel and the online platform. Digital advertising on ITVX has actually been doing quite well recently. So streaming hours have been growing at double digits. The logic of this, as we covered last time, is it's split into two divisions. So it's got media and entertainment, which is going, and then it's got the production side of the business, which is, well, it's actually called the studio side of the business. But what that does is it makes and distributes shows in the UK and abroad, and it licenses out some of these ideas to other TV companies. So as an example, Love Island, massively popular in the UK, that's been licensed out. You've now got like Love Island Australia. I think there's Love Island in other countries as well, but that's been really successful. The studios business, it does currently have a 2.1 billion content supply agreement with ITV and Sky. My concern would be the longer this goes on, Sky are producing their own content, I think, quite aggressively based on adverts I've seen for Sky TV shows. And how long are they going to keep this supply agreement in place once it's expired? And I think what works really well with those two businesses together is, yes, you've got a really good studios business that they've built up in the last kind of 10 or 15 years and has actually really done really well, I think, in terms of the way they've managed to survive in like a post-Netflix world. And part of why that was so successful is they have to produce this for ITV. And then if it works, they can then go and license it out. And they've got these formulas that they can then go apply in other countries. Now, if you don't have ITV, I think that becomes a lot harder. So yeah, my concern would be short to medium term, it maybe makes a lot of sense, but I think longer term, those businesses were stronger together. In terms of the price, it's a forward P of 9.5. That compares to a 10-year average of 9. The prospective yield is 6.2, and that compares to a 10-year average of 6.1. So if I was a shareholder, for me, I would be getting out on this news. I really don't like it. I think it's a long term, I think it's a mistake. What about you, John?
Yeah, it's not a business that I like. I think the quality isn't there. I don't think the IP is there as a whole. And it's an incredibly competitive market. So I hear why some people are making the value argument with it, but I just don't see it.
I think they're just going back to the quality. This isn't the best defense for it, but I think the quality was never there.
Yeah.
I don't think they've had much quality for a long, long time, and arguably never did. But when there was 3 channels, it was less of an issue. But I think considering how low I would consider the quality, if you'd have kind of shown me the quality of the competition 20 years ago and said you're going to have Netflix, Disney Plus, Hulu, whatever else, cranking out all this original content, I'd have just said, oh, and as well, I mean, I know this is now no longer fully the case, but as well, these platforms don't have any adverts. I'd have just said they're dead.
Yeah.
And I think given what I think they've done very well with what they've got. that doesn't make them a high quality business, but I think the way they managed to survive in that post Netflix Amazon world, I think they actually did an all right job. It doesn't change the fact that it's not a business you'd want to invest in, but I think management performed well with the assets they actually had.
For sure.
But yeah, I think this division, well, the sale of this division, I do think it's a mistake, because I think it puts the remaining part of the business in a much weaker position.
Yeah, no, fair points.
So should we move on to I think another debut on the show,
Yes,
Intuitive Surgical?
It is. So it says what it does on the tin. So it's a surgical equipment manufacturer, and it's responsible for the Da Vinci robot, which is essentially a robotic aid to surgeons. So they basically have lots of different ports which have surgical equipment which are inside a patient. It can be used for a number of different types of surgery. And then you almost have a control panel within the room, and it can sort of give you a 3D immersive image of what's happening within the patient, and you can control it. You can have multiple different sort of, I suppose, arms and controllers, so you're not just limited to sort of two hands, as it were. And it's by far and away the market leader when it comes to robotic surgery, and it has been that for a number of years now. It's a US based, and they have more than 11,000 of these robots worldwide, which support more than 3.1 million operations a year. So anyway, they had their second quarter results out last week. So they had second quarter revenue rising 18.5% to $2.9 billion, with system sales and recurring revenue streams growing at similarly strong rates. Underlying operating profit was up 28.7% to $1.2 billion. And that was driven by revenue growth, gross margin improvement, and continued cost discipline. Cash on hand rose by around $700 million quarter on quarter, supported by strong cash generation from the businesses. And Intuitive also spent around $400 million on share buybacks. Management kept full-year procedure growth guidance at between 13.5% and 15.5%, but expects outcome to be closer to 14.5% at the midpoint, against a backdrop of slower US growth. Underlying gross margin guidance improved slightly and helped by a better mix and lower tariff costs. And the shares were down nearly 11% in after-hours trading. In terms of valuation, Intuitive Surgical has a market cap of $122 billion and trades at nearly 36 times forward earnings, compared with a 10-year average of just under 49. I thought these results were really impressive. I think it's a very interesting company, and I believe the estimated market share is between 60 and 80%. So it's not quite monopoly, but it's got, by far and away, it is the market leader. Valuation seems fairly toppy, but I guess if you're thinking about something that's approaching sort of a monopoly and it's so far away from its nearest competitors, and if you say that one of the limiting factors with the robots is that, one, they're expensive, but the cost arguably may come down as we go forward with it, particularly when you're seeing the advantages that they have, but also with new, younger surgeons coming through. So you have a generation who won't train on the robots, and they're perfectly capable of doing the procedures that they were doing without the robot, with sort of older techniques, I suppose, if you want to put it that way. And with the younger surgeons who are coming through, more and more of them will be robotic trained. So I think you will see the use of it going up and up with time. For me, and this is more because it's the first time that we've looked at it, more on the surface, the things I'd be concerned about are the valuation, and if there were a new competitor. So Johnson & Johnson have a competitor called Atava. It's still very early, but that is a big company that's backing an alternative. And you've got some other ones. You've got Medtronic, who are in the industry as well. And there is Microport Medbot. So there are a couple of others. And whilst this is the market leader, if that was eroded, and if one of these ones, or potentially one we don't even know, came through, then it's got a long way to fall at its current valuation. I'm not saying that that's likely, but I think for me at this stage, I would want to dig into that a lot more before considering sort of investment in it. And as I say, on the surface at least, it's a pretty toppy valuation. Sam, what are your thoughts?
I think it's interesting. I think it's expensive, but so on a trailing PE, it's 44. But then forward, it's only 36 only. But you can see it's coming down quite quickly. The operating profit is up by more than the revenue, which is good because the margins are improving, but it does look like that has been more on the cost side. But I think the margins actually look pretty good as well when you consider that it's basically selling machines. So it did 2.9 billion with underlying operating profit of 1.2 billion. That's like a 30% EBITDA margin, which for something that manufactures machines is really good.
I wonder whether some of the servicing and the sort of recurring revenue is coming into that.
Okay, that would make sense. But I mean, it says the machines are $2 million each. I don't know if that's just the starting price.
Probably, yes. I remember this is going back, and this was all sort of secondhand anecdotal, but I remember 15 years ago, there was, this is in the UK context, they were being talked about, they're £1 million each as a kind of a start. And
they've come down.
Well,
sorry, no, they've not. They've doubled.
So I was going to say, well, if you say adjusted for inflation, etc., it's probably not totally similar, but they will have gone up a bit.
So have you come across them at all in the UK?
100%. Most big hospitals will have.
Really?
Yeah.
But then my concern would be, well, the market cap's 122 billion. You need to sell a lot, even at 2 million, you need to sell a lot of machines. And how often do you need to upgrade them? How long do they last?
Yeah.
At what point do you get, you know what I mean? This isn't like an iPhone where you're going to get a new one every year. Do you need the newest model? And at what point you say, well, actually, the current one's only 2 years old.
Yes.
We don't need one for a while now. And that would be my concern with it. How long are those cycles? And how big are the upgrades from one generation to another?
Yeah. And these are the questions that I don't know. I think we're so far from saturation point in terms of them being sold in the UK market, at least. I don't know what it's like in the US, because you could be closer to sort of saturation point. And then you are talking about, well, what's the next model going to do and how often do we need to upgrade them? I suppose the other thing is that in terms of worldwide growth, you're probably, a lot of places won't have been able to afford them, but centres may be getting them more in, I guess, Europe developing and then going kind of more developing world after that. But yeah, these are the things I don't know. Obviously, you've got the recurring revenue from the maintenance of them, but you can't just rely on that. And I think these are some of the questions where we need to do more research.
I think the UK, though, is quite an interesting case study, just because I would imagine that we were quite a bit behind the US in adopting them. Because you think with the money in, obviously, healthcare in the US, these would have been in hospitals a lot quicker because there is just more money kind of sloshing around for that kind of stuff.
Yeah.
Whereas for the UK to actually buy into the point where they're in kind of every hospital, I think that does speak a lot to how good the machines actually are.
Yeah. And then it's a case of, well, how many does your hospital have? Do you have one? Do you have five? You're getting to those kind of
questions.
I'd
definitely cover it again, but I imagine it might end up being one like ASML, where we sat here in a year or two, we finally understood it, and we say, well, I can't believe how cheap it was in July 26, and we were saying it was expensive, but that's life.
Yeah, no, 100%. Well, let's see. Okay, so of the companies this week, Sam, what would be your top pick and what would come last?
So I think last is easy. That's Ocado.
Yeah.
I think top's quite tough, actually. I think I'd probably play it safe and just go with Barratt Redrow. I think it's not the best business, but when you factor in the valuation, I'd be much more comfortable owning it.
Yeah.
What about you?
Very boring, but the same, and it's for the same reasons. I think if you were playing fantasy portfolio with this, it would be very easy to go for ASML or Intuitive Surgical. But with my own money, I have actually done it with my own money, Barratt Redrow. But yeah, it's difficult. It's obviously not of the quality of ASML or Intuitive Surgical for that matter, but valuation does appeal.
I do think, though, of the two, though, I think I'd probably pay up for ASML before Intuitive Surgical, but I guess we've been covering it for a couple of years, so it's maybe an unfair comparison.
Yeah.
The initial glance is the quality does look like it's there.
Yeah, no, 100%.
Right.
Okay, thank you very much for listening. We'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.